Bank earnings are here. What JPMorgan, Wells Fargo, and Citi results mean for your money. Three of the biggest banks in America are about to reveal their cards, and what they say next week could move the entire stock market. JPMorgan, Wells Fargo, and Citigroup all report earnings starting April 14th, and whether you own bank stocks or not, this affects you. Stick around. In the next 6 minutes, I'm going to break down exactly what analysts expect, what to watch for, and what it means for your money. Why bank earnings matter to everyone. Euro 40, 130. Before we get into the numbers, let me answer the question some of you are already thinking. Why should I care about bank earnings if I don't own bank stocks? Here's why. Banks are the engine of the economy. When banks are doing well, they're lending money to businesses, hiring is up, the economy is growing. When banks start struggling, it usually signals trouble ahead for everyone's portfolio, not just bank investors. The finance sector is actually the second largest earnings contributor to the S&P 500, right behind tech. So this stuff moves markets. What analysts are predicting? Let's talk numbers, starting with JPMorgan, the biggest bank in the country. Analysts are expecting earnings of about $5.38 per share, which would be around 6% growth compared to last year. That might not sound like a lot, but remember, this is a $795 billion company. 6% growth at that scale is enormous. Now look at the bigger picture. For the entire finance sector, Q1 earnings are expected to jump nearly 20% compared to a year ago. That's huge. The question is whether the actual results live up to those expectations or disappoint. For Wells Fargo specifically, the big number to watch is their net interest income. That's basically how much money they make from loans versus what they pay out on deposits. Wells is targeting around $50 billion for 2026, up from $47.5 billion last year. If they beat that, the stock likely jumps. If they miss, it could slide. Why bank stocks had a brutal Q1? Now here's the important backstory. Bank stocks got absolutely hammered in Q1 2026. The S&P 500 financial sector dropped nearly 10% in just 3 months. Wells Fargo alone was down 17% from its January highs. So why did this happen? 3 things hit banks at once. First, the US-Iran conflict sent oil prices spiking, which hurt consumers and clouded the economic outlook. Banks hate uncertainty. Second, there were real cracks showing in something called the private credit market. But basically, some private investment funds started limiting withdrawals, and investors got nervous about banks that lent money to those funds. Third, AI fears. Investors started worrying that AI would automate so many jobs that it would hurt consumer spending and loan demand for banks, but here's what changed. A ceasefire announcement in the Middle East sparked a rally in bank stocks. Banks are what Wall Street calls cyclical stocks, meaning when fears of recession ease, bank stocks can bounce back fast. The question now is, can earnings confirm that the worst is over? What to actually watch on earnings day? So you want to watch the earnings reports on April 14th. Here's exactly what to listen for. Number 1, loan growth. Are more people and businesses borrowing money? Growing loans equals a growing economy. That's a green flag. Number 2, net interest margin. This is the spread between what banks charge on loans and what they pay on deposits. If this is shrinking, it means pressure on profits. Number 3, management guidance. This is huge. What do the CEOs say about the rest of 2026? Are they optimistic or cautious? Markets react to the forward outlook just as much as the actual numbers. And number 4, investment banking revenue. For Goldman Sachs, reporting April 13th, and JPMorgan, this is the big one. More mergers, more IPOs, more deals equals more fees equals more profit. What this means for your money. Alright, let's bring this home. What does all of this mean if you're a regular investor? A few things. If you hold index funds like the S&P 500, you already own these banks. Finance makes up about 13% of most S&P 500 funds. So a big move in bank stocks will move your portfolio whether you realize it or not. If you're thinking about buying individual bank stocks, and this is not financial advice, always do your own research. JPMorgan is what analysts call a fortress balance sheet stock. It's held up better than most banks during the uncertainty, and analysts have a consensus price target of around $334 per share, which implies about 13% upside from today's price. The main risk? If earnings disappoint, or if bank CEOs sound nervous about the second half of 2026, we could see another leg down in bank stocks, and that would likely drag the broader market with it. So April 14th is a date every investor should have circled. outro, and call to action. That's the full breakdown on what to expect from bank earnings this week. After April 14th, I'll be putting out a follow-up video reacting to the actual results and what it means going forward. So make sure you're subscribed so you don't miss that. If you found this helpful, drop a like. It really does help this channel grow. And let me know in the comments, are you buying bank stocks before earnings, or are you waiting to see the results first? I'll be reading every comment. See you in the next one.